Well, and that's exactly what we're talking about today. It's not this isn't to try to motivate somebody to go buy a home, especially if they're not in the right, you know, especially if it's not the right time for them. Maybe they don't qualify right now, or maybe it's just not, not a good time for them, and that's okay. This is really just for information purposes. For yeah, well, so yeah, to kind of take some of the guesswork, to take the vagueness out of it, right? In these assumptions, if we don't, I'd say typically if we don't have all of the details, all of the information, our assumptions are kind of based on worst case scenario. Would you agree? Yeah. Um, so that's why I put this together to just really to use some factual data, and use forecasts, not my forecasts. I'm certainly not the smartest guy in the room. I try to surround myself with a bunch of smart people. But this is based on like 19 of the most brightest, smartest economic forecasters, right? So what we did here is we took a home that was priced at 500,000 in 2022, and I've got what current or what interest rate was at that time. And this is based on Freddie Mac's primary mortgage market survey. So you can Google Freddie Mac PMMS, Paul, Mary, Mary, Sam. If you Google that, you're going to see what the average interest rate is across the country. And the good thing, what I like about Freddie Mac in this interest rate survey, if you will, is Freddie Mac has no dog in this hunt. They're not trying to get you to come knock on their door to apply for a mortgage. They don't do mortgages. They don't originate mortgages. They insure lenders. So they insure mortgages. So they have no reason to advertise lower interest rates than is actually available in the market. You get on like fakerate.com, also known as Bankrate, some of the other large internet kind of aggregators of leads, if you will. Let's say today's interest rate is 7%. You might see an online lender advertising 5.75, and and I know immediately that that's BS. The market is not offering 5.75 on a 30-year fixed rate today, when interest rates are closer to 7, unless you're buying it down. So that's why I really like Freddie Mac's primary mortgage market survey. And this is something that I recommend clients go to, just kind of keep me honest, right? To make sure that what I'm offering and what I've prepared for them is what is available in the market. And Freddie Mac updates this every single Thursday. Every Thursday morning, Freddie Mac updates their survey. They survey a host of lenders and banks and independent mortgage banks across the entire country. And they've been doing this since, I think, 1971. So you can actually go back and look at, on a weekly basis, kind of what have interest rates been doing every single week for year to date, or last year, or the last 3 years, or whatever time frame that you want. So again, circling back to the analysis that we've prepared here, we're basing this on a home that sold for $500,000 in 2022. You've got the interest rate there based on Freddie Mac's survey, and I'm using appreciation rates based on CoreLogic's Case-Shiller Home Price Index. And this is really the most fair one that I can find, and that I kind of refer to most of the time. So based on a $500,000 purchase price in 2022 at an interest rate of X, I'm illustrating what was that mortgage payment. And this is with 20% down. All of these are with 20% down, just to keep things nice and simple. This way we didn't have to incorporate mortgage insurance or anything else. So 20% down on 500,000 in 2022. Here's what the estimated monthly payment would have been, and here's what your total, what I call cash to close, or that total outlay of cash due at closing. In other words, that total check that you're writing at closing. That's what these numbers would look like. And then we fast forward using appreciation rates, statistical, factual appreciation rates from CoreLogic's Case-Shiller Home Price Index in 2023. So what did home prices do from 22 to 2023? And then what were interest rates at that time period as well? So you're going to see both of those reflected in there, and you're going to see what happened, how did that impact the monthly payment and the cash due at closing on that $500,000 home from 2022. So in other words, if you delayed or if you waited a full year from 2022 to 2023 because you wanted home prices to come down, or you wanted interest rates to come down, or whatever the reason was, this is what that home would cost you, and this is what it would cost if you waited a year. So you go from roughly $3,700 a month to $4,200 a month if you waited a year. Why? Because interest rates crept up quite a bit, and then based on a 4.8% appreciation rate year over year from 22 to 23, that $500,000 home, now you're paying $524,000 for it. You follow me? Right. So it impacts everything. So your payment goes up, the cash that you need at closing goes up, and so on and so forth. Now, let's fast forward to 2024, to just this past year. What did that $500,000 home in 2022 cost you in 2024? Well, from 22 to 23, at 4.8% appreciation, that $500,000 house cost you $24,000 more dollars. And in 2024, at a 3.6% year over year appreciation rate in that same time period, that $500,000 house that jumped to $524 now costs you $542,000 and some change. So you'll see on this analysis how that impacts monthly payment and, again, that cash to close. Now, interest rates did drop from the peak of 2023 to 2024. So you're going to see a little bit of relief there, but not as much as you would like. While you see a little bit of relief in the monthly payment, you're still paying more for the home. So you have more cash that's due at closing, right? And then we look at forecast. If we forecast 1 year out using this same time period, and I took this appreciation rate that I'm using here, I think it's 3.1%. I'm using an average of 19 economists, 19 big economists. These aren't guys and gals like me. They're a lot smarter than myself. So this shows you if you were to delay your purchase, and this is for folks that maybe you're in a position to buy right now. All the stars align, you qualify, you're comfortable with the monthly payment, but maybe the only reason that you're delaying it is because you're thinking rates are going to come down, or you're thinking that home prices may come down. So this is really for those that do qualify right now today. They're in a position right now to buy today. They have the wherewithal to do it. They're just delaying because maybe they're hearing and seeing things in the media about a housing crash or interest rates, falling more than a point and a half, 2 points, which neither one of those are going to happen this year in 2025. So again, I'm using appreciation rates based on 19 economists in their forecasts, and I'm using an interest rate based on very similar thing. You've got MBA, you've got NAR, you've got Fannie, you've got Freddie, you've got Wells Fargo, Redfin. There's a number of economists that I've essentially aggregated here to get an idea of what interest rates would be at the same time frame, same time point, 1 year from each one of those other scenarios. So take a look at this. Feel free to share it. Because I think this is an eye opener when somebody looks at this. Because let me back up. If I'm thinking I don't want to buy that house, maybe I even went and saw a house or a couple of houses with my real estate professional, and it's priced at $500,000. And if the media is telling me that home prices are going to not crash, but maybe they're going to fall, maybe they're going to fall just a little bit, I'm thinking in my mind, if I sit tight, I can buy that home for less in 12 months or 11 months or 10 months, right? Or if I'm also hearing that interest rates peaked and the Fed's just going to keep cutting and rates are going to be a lot lower, I'm going to wait because that home, I can get a better rate. So it's going to cost me less, which that in itself doesn't make a ton of sense because that the actual price of the house is going to continue to appreciate in most cases, right? So even if your rate drops a bit, as you can see in scenario number 3 in this analysis that I prepared, even though the interest rate dropped a little bit, you're still shelling out more cash than you were 1 year previous to that because of appreciation. So while appreciation might be decelerating, it's not reversing, it's not negative. So it doesn't matter if that home appreciates at 3% per year or 20% per year. It doesn't matter. Bottom line is that home that you're looking at today is going to cost you more tomorrow, right?